The Australian property market is at a turning point. After years of massive growth, record prices, and constant headlines about the housing crisis, everyone wants to know the same thing. What's going to happen over the next 5 years? Will prices keep climbing? Will they finally crash? Should you buy now or wait? And most importantly, where should you be putting your money? I've analyzed data from every major bank, property research firm, government forecast, and economic institution to give you a complete picture of what's likely to happen in Australian property between 2026 and 2030. This isn't guesswork. This is based on real trends, actual data, and expert predictions from people who've been right before. By the end of this video, you'll understand exactly what's coming for each Australian capital city, which areas will see the biggest growth, what risks could change everything, and most importantly, how you can position yourself to benefit from what's ahead. Let's start with the big picture before we dive into each city. The national picture. What's driving the market? Australian property prices have been on an incredible run. Over the past 5 years, the national median dwelling price has jumped over 50%. That's extraordinary growth by any measure. Right now, the typical Australian home costs around $844,000. 5 years ago, it was about $560,000. That's nearly $300,000 in growth. The question everyone asks is whether this can continue. And the answer, based on every credible forecast available, is yes, but the growth will be slower and more uneven than what we've seen recently. Domain forecasts national property price growth of 4 to 6% annually over the next few years. The major banks are slightly more conservative, predicting between 3 and 7%, depending on which bank and which year. Some independent researchers, like SQM, are more bullish, suggesting 6 to 10% growth is possible in 2026. If we take a middle ground estimate of around 5% average annual growth between 2026 and 2030, that would take the national median from $844,000 today to roughly $1.08 million by 2030. That's another $236,000 in growth over 5 years. But remember, these are national averages. Some cities will do much better. Some will do worse. Some suburbs will double in value, while others barely move. The key to making money in property over the next 5 years is understanding which markets will outperform and why. So what are the big forces that will drive Australian property prices over the next 5 years? There are 5 major factors you need to understand. First, population growth. Australia's population is growing fast. We currently have about 27.6 million people. By 2030, we'll have over 30 million. That's an extra 2.4 million people who need somewhere to live in just 5 years. Even if we're conservative and say each household has 2.5 people on average, that's still nearly 1 million new households that need housing. Second, housing supply shortage. Australia needs to build between 240,000 and 280,000 new homes every year just to keep up with population growth and replace old housing stock. In 2024, we only managed about 163,000 dwelling approvals. That's roughly 70,000 to 120,000 homes short every single year. The National Housing Accord set a target of 1.2 million new homes by 2029. Most experts agree we'll fall massively short, possibly by 400,000 to 500,000 homes. This supply shortage isn't getting better. Building costs have gone up dramatically, materials are expensive, labor is scarce. Many developers can't make projects financially viable at current prices. This means the shortage will continue and probably get worse through to 2030. Third, interest rates. The Reserve Bank has already cut rates 3 times in 2025, bringing them down from 4.35% to 3.6%. Most economists expect at least one or two more cuts in 2026, with some predicting rates could fall as low as 2.6% to 3.1% by early 2027. Lower interest rates mean people can borrow more money and afford higher property prices. Every time rates drop by 0.25%, it adds thousands to people's borrowing capacity. Fourth, rental market pressure. Rental vacancy rates across Australia are sitting at just 1.5%, about half the normal level. This is incredibly tight. When rentals are this hard to find, rents go up dramatically. Higher rents make owning property more attractive for investors because they can charge good rent. It also forces renters to consider buying if they possibly can, which adds more buyers to the market. Fifth, employment and wages. Australia's unemployment rate is around 4%, which is very low. Almost everyone who wants a job can get one. Real wages are growing for the first time in years, meaning people's actual purchasing power is increasing. When people have secure jobs and growing incomes, they're confident to borrow money and buy property. These five forces all point in the same direction: upward pressure on prices. Unless something dramatic changes with one or more of these factors, Australian property prices will keep rising through to 2030. Now let's look at what this means for each capital city, because the differences are huge. Sydney, steady growth from a high base. Sydney remains Australia's most expensive property market, and nothing in the forecasts suggests that's going to change. The median Sydney dwelling price is currently $1.23 million. For houses specifically, it's around $1.7 million. For units, it's about $835,000. Domain forecasts Sydney house prices will grow 7% in 2026, reaching approximately $1.83 million. Unit prices are expected to grow 6% to around $889,000. If these growth rates continue at a slightly slower pace through to 2030, we could see Sydney's median house price hit $2.2 million to $2.4 million by 2030. That sounds insane, but remember, Sydney has always been expensive and has always grown. PropTrack's modeling suggests if the past 5 years' growth repeats, Sydney houses would reach $2.4 million by 2030, up 61% from today. Units would hit around $930,000, up 11%. Why will Sydney keep growing? Several reasons. Sydney is Australia's economic powerhouse. It has the highest concentration of high-paying jobs. It's where the big corporations are based. It's Australia's global city. People with money want to live in Sydney, and they're willing to pay premium prices. Sydney also has geographic constraints. The city is bordered by ocean, national parks, and mountains. There's limited land for expansion. This naturally restricts supply, which supports prices. Interest rate cuts will disproportionately benefit Sydney. Historically, Sydney and Melbourne respond fastest to rate changes because they have the most buyers at the margin who are constrained by borrowing capacity. When rates drop and borrowing capacity increases, these buyers flood into the market, pushing prices up quickly. However, Sydney's growth will be slower than smaller capitals. Sydney is already so expensive that affordability is a genuine barrier. Even with lower interest rates, many people simply can't afford Sydney property. This caps how fast prices can grow. Within Sydney, the best growth will come from areas benefiting from infrastructure investment. The Sydney Metro expansion, WestConnex completion, and Sydney Gateway opening are all improving access to previously less connected areas. Suburbs around new metro stations will see above-average growth. Western Sydney, particularly areas near the new airport and around Parramatta, will likely outperform expensive eastern and northern suburbs. Parramatta is genuinely becoming Sydney's second CBD, with billions in investment. Suburbs within 10 kilometers of Parramatta will do well. The lower North Shore and eastern suburbs are already at such high prices that growth will be slower. These areas will still grow, but perhaps 3 to 4% per year rather than 6 to 7% per year. For investors, Sydney offers stability and steady growth rather than explosive returns. For first-home buyers, Sydney remains extremely challenging. Unless you have family help or very high income, you're realistically looking at units in outer suburbs or waiting longer to save bigger deposits. Melbourne, the recovery story. Melbourne has been the weakest performer among major capitals over the past few years. The median Melbourne dwelling price is currently around $803,000. Houses are approximately $1.05 million, and units are about $555,000. This weakness actually creates opportunity. Melbourne is now cheaper than Brisbane, Adelaide, and Perth, which seems absurd given Melbourne is Australia's second largest city with 5 million people. This pricing gap won't last forever. Domain forecasts Melbourne house prices will grow 6% in 2026 to around $1.11 million, with units growing 5% to about $584,000. If Melbourne maintains 4 to 6% annual growth through to 2030, houses could reach $1.3 million to $1.4 million by 2030, with units around $700,000 to $750,000. PropTrack's modeling suggests if the past 5 years repeat, Melbourne houses would only reach $1 million by 2030, up just 17%. This reflects how weak Melbourne has been. But most experts think Melbourne will bounce back stronger than this suggests. Why has Melbourne been weak? Several reasons. Melbourne had the world's longest COVID lockdowns, which damaged business confidence and drove people away. Victoria has higher property taxes than other states, particularly land tax, which discourages investors. Melbourne has actually built more housing than other capitals, which increased supply and kept prices down. And Melbourne's economy has been softer than Sydney or Brisbane. But things are changing. Interest rate cuts will help Melbourne significantly. Melbourne has many buyers who've been sitting on the sidelines waiting for the right time. Lower rates will bring them back. Melbourne's relative affordability compared to Sydney and Brisbane will attract interstate buyers looking for value. And Melbourne's strong employment, world-class education, and livability will always attract people. The areas to watch in Melbourne are the middle ring suburbs. Places like Reservoir, Preston, Coburg in the north, Footscray, Yarraville, Altona in the west, Oakley, Clayton, Springvale in the southeast. These suburbs are gentrifying as younger buyers priced out of inner suburbs move further out, but still want good access to the city. Melbourne's outer suburbs will have mixed performance. Growth corridors like Wyndham and Melton in the west have huge supply coming, which will moderate price growth. But areas with good transport links will do better than areas dependent on cars. Melbourne's inner suburbs are already expensive, but will see steady growth driven by their scarcity and desirability. Suburbs within 10 kilometers of the CBD will grow 4% to 6% per year consistently. For investors, Melbourne represents good value right now. You're buying into Australia's second largest city at prices cheaper than much smaller capitals. The risk is that Melbourne stays weak if Victoria's economy doesn't improve or if property taxes increase further. But the upside is significant if Melbourne returns to its historical performance. Brisbane, from boom to sustainable growth. Brisbane has been the star performer over recent years. The median Brisbane dwelling price is now $935,000, having grown an incredible 68% over 5 years. Houses are approximately $1.04 million, and units are $671,000. Brisbane has now overtaken Melbourne to become Australia's second most expensive capital. This is a massive shift. 10 years ago, Brisbane was the affordable alternative. Now it's genuinely expensive. Domain forecasts Brisbane house prices will grow 5% in 2026 to around $1.09 million, with units growing 5% to about $701,000. This is significantly slower growth than Brisbane has been experiencing. If Brisbane maintains 4 to 5% annual growth through to 2030, houses could reach $1.25 million to $1.35 million by 2030, with units around $850,000 to $900,000. PropTrack's modeling suggests if the past 5 years repeat, Brisbane houses would reach $1.53 million by 2030. Most experts think this is too aggressive and growth will slow significantly. Why has Brisbane grown so much? Interstate migration has been massive. People from Sydney and Melbourne have been moving to Brisbane in huge numbers, attracted by lower prices, better weather, and good lifestyle. The 2032 Olympics announcement drove huge investment and excitement. Brisbane's economy has been strong with good employment growth. And Brisbane genuinely was undervalued compared to Sydney and Melbourne for years. But Brisbane's explosive growth is moderating. Prices have risen so much that affordability is now an issue. Brisbane is no longer the cheap alternative. Interest rate cuts won't boost Brisbane as much as Sydney or Melbourne because Brisbane's prices are already at levels where many buyers are stretched. However, Brisbane still has strong fundamentals supporting continued growth. The Olympics in 2032 will drive ongoing infrastructure investment for the next 7 years. The Queensland government is investing billions in transport, stadiums, and urban renewal. Brisbane's population is forecast to grow by 500,000 people by 2046. The city's economy is diversifying beyond mining and tourism into technology, education, and healthcare. Within Brisbane, the best growth areas will be inner-city suburbs benefiting from Olympic infrastructure. Suburbs around new cross-river rail stations like Woolloongabba, Bogo Road, and South Brisbane will do well. Suburbs near Olympic venues in Brisbane South will benefit. Outer suburbs like Logan, Ipswich, and the Moreton Bay region will have slower growth because huge supply is being added. Growth corridors always see supply additions that moderate price growth. Brisbane's units will likely outperform houses over the next 5 years. Brisbane's unit market has underperformed houses significantly, creating a value gap. As affordability constraints bite, more buyers will choose units over houses, pushing unit prices up faster. For investors, Brisbane offers good rental yields and solid growth prospects, but the explosive returns of 2021-2024 are over. You're buying into a market that's already had its boom. For first home buyers, Brisbane is now genuinely expensive, and you need to be realistic about what you can afford. Perth, riding the resources wave. Perth has been the surprise performer recently. The median Perth dwelling price is now $832,000, up an incredible 75% over 5 years. Houses are approximately $935,000 and units are $520,000. Domain forecasts Perth house prices will grow 5% in 2026, with units growing 6%. If Perth maintains 4 to 6% annual growth through to 2030, houses could reach $1.15 million to $1.25 million, with units around $680,000 to $740,000. PropTrack's modeling suggests if the past 5 years repeat, Perth houses would reach $1.55 million by 2030, up 66%. Most experts think this is too high, and growth will moderate significantly. Perth's boom has been driven by several factors. Western Australia's mining sector has been booming with high iron ore prices. This creates high-paying jobs and brings workers to Perth. Perth was genuinely cheap compared to East Coast capitals, making it attractive for investors. And Perth had very tight supply, with limited new building, creating a supply squeeze. The question is whether Perth's growth is sustainable. There are reasons to be cautious. Perth's economy is heavily dependent on mining, which is cyclical. When iron ore prices fall or China's demand weakens, Western Australia's economy suffers. Perth has boom-bust cycles historically, and this looks like a boom phase that will eventually moderate. Perth's current prices have run ahead of fundamentals in many suburbs. Investor demand from the East Coast has driven prices up quickly, particularly in cheaper suburbs. When this investor demand slows, those suburbs will struggle. However, Perth has genuine long-term strengths. Western Australia has enormous mineral wealth that will be in demand for decades as the world transitions to renewable energy. Perth is Australia's most isolated capital, limiting interstate competition. And Perth offers genuine lifestyle appeal, with beaches, weather, and relatively lower density than East Coast capitals. Within Perth, the northern suburbs and beach suburbs will see the strongest growth. Areas like Scarborough, Trigg, and North Beach are gentrifying. The northern corridor benefits from employment in the CBD and coastal lifestyle. Southern suburbs like Rockingham and Mandurah will have slower growth due to distance from employment centers. Perth's units represent value. The gap between house and unit prices in Perth is large. As affordability constraints hit, units will become more attractive, pushing their prices up faster than houses. For investors, Perth is high risk, high reward. If Western Australia's economy stays strong, Perth will continue growing well. If mining slows, Perth could stagnate or fall. You need to understand this risk. For first home buyers from Perth, the opportunity to get into the market at current prices is closing quickly. Adelaide. Still value, but for how long? Adelaide has been another standout performer. The median Adelaide dwelling price is now $843,000, up a massive 75% over 5 years. Houses are approximately $1.01 million, and units are $568,000. Adelaide has become more expensive than Melbourne. Let that sink in. Adelaide, a city of 1.4 million people, now has higher median prices than Melbourne, a city of 5 million. This shows how much Adelaide has grown and how weak Melbourne has been. Domain forecasts Adelaide house prices will grow 4% in 2026 to around $1.05 million, with units growing 3% to about $586,000. This is significantly slower than Adelaide's recent growth. If Adelaide maintains 3 to 5% annual growth through to 2030, houses could reach $1.15 million to $1.3 million, with units around $660,000 to $720,000. PropTrack's modeling suggests if the past 5 years repeat, Adelaide houses would reach $1.47 million by 2030, up 75%. Most experts think this is unrealistic, and growth will slow substantially. Adelaide's boom has been driven by affordability and lifestyle. Adelaide was genuinely cheap compared to other capitals. It offers great lifestyle with wine regions, beaches, and manageable size. Interstate migration has been strong as people discovered Adelaide's appeal during COVID. And Adelaide had limited supply with slow building activity. But Adelaide's growth is slowing. Prices have risen so much that affordability is becoming an issue. Adelaide is no longer the budget option. The gap between Adelaide and Melbourne is now so small that some buyers are choosing Melbourne over Adelaide for better employment and opportunities. However, Adelaide still has genuine appeal. South Australia's economy is growing with defense contracts, renewable energy projects, and advanced manufacturing. Adelaide offers excellent quality of life with low traffic, good schools, and strong community feel. And Adelaide still offers better value than Sydney or Brisbane. Within Adelaide, the northern suburbs like Elizabeth, Salisbury, and Playford have seen explosive growth, but are now expensive relative to their fundamentals. These areas grew 100% in 5 years, which is unsustainable. Growth will slow significantly here. The southern suburbs and beach suburbs will see steadier growth. Areas like Morphett Vale, Christie's Beach, and the Fluoriu Peninsula offer lifestyle appeal. The eastern suburbs and hills remain expensive, but will grow steadily driven by their established appeal. Adelaide's units represent significant value compared to houses. The median unit price of $568,000 is much lower than the $1.01 million house price. As affordability bites, units will become more attractive. For investors, Adelaide offers decent yields and steady growth prospects, but the explosive returns are over. For first home buyers in Adelaide, it's still more achievable than Sydney or Brisbane, but isn't the bargain it was 3 years ago. Canberra: stability and government employment. Canberra has been relatively flat recently. The median Canberra dwelling price is around $861,000. Houses are approximately $934,000 and units are $532,000. Domain forecasts Canberra house prices will grow 4% in 2026, with units growing 3%. If Canberra maintains 3 to 4% annual growth through to 2030, houses could reach $1.05 million to $1.1 million, with units around $600,000 to $640,000. Canberra's market is driven almost entirely by government employment and the public service. When the federal government is hiring, Canberra's property market grows. When there are public service cuts, Canberra's market softens. Currently, the federal government is stable, with no major cuts planned. This supports Canberra's market. However, Canberra lacks the population growth of other capitals. It's a smaller city with limited private sector employment. This caps its growth potential. Canberra's strengths are stability and strong incomes. Public servants have secure employment and good salaries. This means low default risk and steady demand. Canberra also has strong planning controls that limit supply, supporting prices. Within Canberra, inner suburbs like Braddon, Turner, and Ainslie will see steady growth, driven by their proximity to the city and lifestyle appeal. Outer suburbs like Gungahlin and Tuggeranong will have slower growth due to distance from employment. For investors, Canberra offers stability rather than growth. It's unlikely to boom, but it's also unlikely to crash. For first home buyers in Canberra, the market is reasonably priced compared to other capitals. Hobart: the cooling market. Hobart has been weak recently after a strong COVID boom. The median Hobart dwelling price is around $673,000. Houses are approximately $730,000 and units are $487,000. Domain forecasts modest growth for Hobart through 2026, possibly 2 to 3% for houses and 1 to 2% for units. If Hobart maintains 2 to 3% annual growth through to 2030, houses could reach $800,000 to $850,000, with units around $600,000 to $640,000. Hobart boomed during COVID as people sought lifestyle and remote work opportunities, but that boom has ended. Interstate migration has slowed. Remote work is less common as companies require office attendance, and Hobart's limited employment opportunities have become apparent. Hobart's challenges are its small population, limited economy, and geographic isolation. Tasmania's economy is heavily tourism-dependent, which is vulnerable to economic downturns. Hobart has limited high-paying employment outside government and tourism. However, Hobart still offers lifestyle appeal and is cheaper than mainland capitals. For retirees or people with location-independent income, Hobart remains attractive. Within Hobart, waterfront and city fringe suburbs will hold value best. Areas like Battery Point, Sandy Bay, and South Hobart are established and desirable. Outer suburbs will struggle without employment growth. For investors, Hobart is risky with limited growth prospects. For first home buyers in Hobart, prices are relatively affordable compared to southern capitals. Darwin. The boom-bust cycle continues. Darwin has been strong recently. The median Darwin dwelling price is around $549,000. Houses are approximately $660,000, and units are $437,000. Darwin typically has boom-bust cycles tied to major projects. Currently, Darwin is in a boom phase driven by defense spending, major infrastructure projects, and resource developments. This is pushing prices up quickly. Domain forecasts strong growth for Darwin through 2026, possibly 6 to 8% annually. If Darwin maintains this through to 2030, houses could reach $900,000 to $950,000, with units around $600,000 to $640,000. However, Darwin's history suggests caution. When major projects finish, workers leave, demand drops, and prices fall. Darwin has experienced this cycle repeatedly. The current boom will likely end when current projects complete unless new projects replace them. Darwin's strengths are its strategic location, defense importance, and resource wealth. Northern Australia development is a federal priority. If this delivers ongoing investment, Darwin could sustain growth. For investors, Darwin is extremely high risk. You could make excellent returns if you time it right, but you could also lose significantly if the boom ends. For first home buyers in Darwin, prices are still relatively affordable compared to southern capitals. Regional Australia. The Great Divergence. Regional Australia boomed during COVID, but has been mixed since. Some regional areas continue growing strongly, while others have stalled or fallen. The regional areas that will continue growing through to 2030 share common characteristics. They're within 2 hours of major capitals. They have genuine employment beyond just servicing the local population. They have lifestyle appeal, with beaches, wine regions, or natural beauty. And they have good infrastructure, with hospitals, schools, and services. Areas like the NSW Central Coast, Geelong, the Gold Coast, the Sunshine Coast, Newcastle, and Wollongong will likely see 4 to 6% annual growth through to 2030. These are established regional cities with genuine economies. Areas like Ballarat, Bendigo, Toowoomba, and Launceston will see moderate growth of 3 to 5% annually. They're solid regional centers but have less growth drivers. Remote regional areas and small country towns will likely see minimal growth or even falls. The COVID remote work boom that drove people to these areas has ended. Many people who moved to remote areas during COVID are now moving back to cities as remote work becomes less common. Regional mining towns will boom and bust with commodity cycles. Towns like Karratha, Mackay, and Gladstone will boom when resources are strong and bust when they're weak. For investors, regional areas require careful selection. The best opportunities are in established regional cities near capitals. Remote areas are risky. For first home buyers, regional areas offer affordability but at the cost of employment opportunities and services. The risks that could change everything. All of these forecasts assume current trends continue broadly, but several risks could change the outlook significantly. A global economic recession is the biggest risk. If major economies like the United States, China, or Europe fall into serious recession, it would hurt Australia's economy. Unemployment would rise, immigration would fall, and property demand would drop. This could cause property prices to stagnate or fall. China's economy is particularly important. China buys most of Australia's iron ore, coal, and other resources. If China's economy weakens significantly, it hurts Australian mining, employment, and government revenue. This would particularly affect Perth and regional mining areas. Interest rates could surprise on the upside. If inflation proves harder to control than expected, the Reserve Bank might need to raise rates again instead of cutting them. This would hurt property prices, particularly in expensive markets like Sydney, where buyers are stretched. Government policy changes could affect the market. If negative gearing were removed or capital gains tax increased, it would reduce investor demand. If foreign buyer restrictions increased, it would reduce demand in some markets. If stamp duty were replaced with land tax, it would change buying behavior. Climate change impacts are increasing. More frequent floods, bushfires, and storms affect property values in vulnerable areas. Coastal erosion threatens beachfront properties. Bushfire-prone areas face higher insurance costs or uninsurability. This will create growing price divergence between safe areas and risky areas. Banking regulations could tighten. If regulators force banks to be more conservative in lending, it would reduce how much people can borrow, reducing demand and prices. A major pandemic or health crisis could disrupt everything again, though this seems less likely after COVID. Despite these risks, the most likely scenario remains continued growth across most Australian markets through to 2030, albeit slower and more uneven than recent years. What this means for you. If you're a first home buyer, the message is clear. Waiting for a crash is probably a mistake. Prices are more likely to keep rising than to fall significantly. If you can afford to buy now, you should seriously consider it. Waiting might mean prices rise further out of reach. Focus on affordable markets or affordable property types. If you can't afford a house, buy a good apartment in a strong location. If you can't afford your preferred city, consider a regional center. Getting into the market is more important than buying your dream property immediately. If you're an investor, the next 5 years offer opportunities but require careful selection. Don't just buy any property anywhere. Focus on markets with strong fundamentals, population growth, employment diversity, infrastructure investment, and supply constraints. Sydney and Melbourne offer stability and steady growth. Brisbane and Perth offer higher growth potential but with more risk. Adelaide still offers some value. Regional cities near capitals offer opportunities if chosen carefully. Avoid chasing markets that have already boomed hard. Adelaide's northern suburbs, Perth's outer suburbs, and small regional towns that boomed during COVID are risky. You're buying at the top of their cycle. Consider units in established areas. The gap between house and unit prices is at record highs. Good apartments in strong locations are undervalued relative to houses. If you're an existing homeowner, you're in a strong position. Your property has likely grown significantly in value. You have options. You can hold and continue benefiting from growth. You can upgrade using your equity. You can use equity to buy investment properties, or you can downsize and release capital. The worst thing you can do is nothing while waiting for the perfect moment. The market moves while you wait.